Chris, thanks so much for joining us. Obviously, lots of discussion about this throughout the day. I'm interested in the fact that actually these spin-offs are still a couple of years away. With that in mind, is there still a lot that could go wrong relative to the jump in the share price that we've seen, or are you a big believer in this new strategy?
I think it makes a lot of sense, and it definitely strikes an opportunistic note. It puts a strong, bold, and underline under the fact that with the GCAS sale closing in November, that creates $25 billion plus debt reduction in the fourth quarter, and the external debt is not a large amount anymore. It's still a little big if you consider pension and a few other items, but those were really loaded on at the time when the ratings agencies were looking very critically and holistically. And some of that is a bit dated in terms of modes of looking at the debt. The healthcare spin could actually, it's slated to be 15 to 16 months out, and that's a low risk barometer. I think they probably expect that to occur a little sooner than that.
And how do you value things in the meantime?
Yeah, we're looking to crunch the numbers on a couple different bases and triangulate. They definitely endorsed $7 billion plus in free cash flow in 2023. Now that is a more date certain commitment, and there's nothing rash about that. That's deliberate, calculated, and tied to their external or their internal visibility in the operations of the businesses. Renewables segment is still troubled. It's lagging and looking for a path to consistent profitability, but it's not steering the overall strategy here in their flexibility. This move reflects high liquidity right now, a rapidly normalizing balance sheet, and businesses like aviation, healthcare, and power, which while aviation is waiting for more cyclical recovery, those three businesses, which I would argue are more central and core than renewables, are all on a good, steady, stable operating path.
And spinoffs typically just in the marketplace tend to do well. Chris, I'm curious about the share price reaction today. Earlier in pre-market, it was up around 10%. Now that's really faded down a little. It's up around a little more than 2%. What do you think that is about? What are the risks here that investors are looking at?
GE has always been a stock that's fairly liquid, and at least over the past 5+ years, it's been a confluence of a lot of factors and considerations. I think when you initially trade on a large move, there's a lot of fear of missing out. And then, there ensues some profit taking. So I think it's short-term supply demand dynamics. I think ultimately the free cash flow targets well underwrite the current valuation, and then sum of parts would be the other means of evaluating a free cash flow yield.
A lot of homework to do on this one, valuing three companies. Chris, thank you for joining us with your first take. Chris Glynn.
Thanks for having me.